Forex macro outlook. Israeli strike on Iranian oil infrastructure. 1. Oil supply shock, inflationary risk. A direct hit on Iranian oil production capacity instantly triggers concerns over global oil supply, especially if further escalation threatens the Strait of Hormuz. Markets may price in sustained risk premium on Brent and WTI crude, pushing oil prices higher. Implication: oil importing nations, e.g. India, Japan, EU, face higher trade deficits, weaker currencies, INR, JPY, Euro. Oil exporting countries, e.g. CAD and OK, may strengthen due to improved terms of trade. 2. Safe haven demand rises. When geopolitical risk surges, capital typically shifts towards safer assets. The classic trio, USD, JPY, and CHF, could benefit from risk offlows. However, USD movement may be nuanced due to inflation versus rate path balancing by the Fed. Implication: US dollar to Japanese yen. US dollar to Swiss franc may drop short-term due to yen and franc inflows. Gold appreciation could support AUD and ZAR as commodity-linked currencies. 3. Regional spillover risk, EM currency pressure. Markets will assess whether the conflict expands into the broader Gulf or pulls in regional actors. Emerging markets with high external debt or reliance on oil, e.g. TRI, PKR, EHP, face capital flight, devaluation risk. Implication: flight from EMFX into majors. Central banks and exposed EMs may hike or intervene. 4. Central bank dilemmas. Oil-driven inflation complicates the global monetary outlook. Central banks and inflation-sensitive economies, e.g. ECB, BO, RBI, may have to tighten despite weak growth, creating policy divergence. Implication: divergence trades may favor currencies backed by more hawkish central banks. Watch for shift in interest rate differentials, especially USD versus Euro and GBP. 5. China and demand-side risk. If oil spikes too high, global demand could weaken. China's already fragile recovery may slow further, reducing industrial demand and impacting commodity currencies. Implication: AUD, NZD, and CAD could see two-way volatility, benefiting from oil/metals but pressured by China's slowdown. Caution: Forex markets are highly sensitive to news headlines, and sustained moves depend on escalation patterns, global diplomacy, and central bank reactions. This is not a one-directional trade environment. Volatility and two-sided risk are the themes.